Good afternoon, ladies and gentlemen. Welcome to what will be a two-part special on listed property. I have entitled mine Not Time to Lose the Faith, and I will be examining listed property from a financial planning perspective in this first presentation. And then Michael Porter, our Chief Investment Officer, will do a second presentation, which will be released a little bit later, where he will look at some specific counters that we hold in clients' portfolios and give a greater, more technical, in-depth analysis on the holdings and why we have confidence in clients' incomes and those shares in the portfolio. So what I'd like to start by doing is by moving backwards in time to really just examine a little bit of the route that the property sector has walked up to this point. And I want to highlight that the negative sentiment really started in 2018, and there were a number of things that triggered this. The first one, as you can see, the graph on the left-hand side, was the trailing reduction in GDP growth. In other words, business in South Africa was slowing down, it was becoming difficult to grow, and that linked to an abundant amount of corporate property that had been built over the preceding 5 years. There was a feeling that there was an excessive demand, an excessive supply of properties and not enough demand. And so there was some sort of concern that consumers and business was under pressure, and so rental yields might be at risk. I think the second thing is that at the end of 2017, those of you will know that Steinhoff collapsed in rather spectacular fashion. And in early 2018, there was massive speculation that the company called Viceroy, who had supposedly released a very detailed report that they had been investigating Steinhoff for some time and were going to come out, and they released this rather damning report. There was a lot of speculation about other companies that they might also be targeting, among them Aspen and the Resilient Property Group, which included Resilient and Fortress. As it turned out later, they targeted Capitec, who defended themselves strongly. But at that time, because of the concern, investors were put to flight. And we can see in the right-hand graph that is the 2017, 2018, which covers many of the lines there of the what's known as the Resilient Group. So that would be NEPI, Resilient, Fortress, and MAS, and they all reflected in that space there. And you can see they all came under pressure. The other thing that also happened at that point and was kind of precipitated from that was that many of these properties at the time were trading at a premium to their net asset value. In other words, the value per share exceeded the underlying value of a property themselves. But investors were prepared to pay a premium in order to secure their income because there was a perception of quality. Now, whether it was entirely due to the concern around some of the malfeasance that was raised in the Resilient Group or not, the listed property sector went the other way. And as a result, prices went to the point where they then traded at a discount to their net asset value. And we can see that that drop in that right-hand graph there. I must point out that many of the accusations, and there was a Financial Services Board, which later became the Financial Services Control Authority, did a full investigation into the Resilient Group, and during the course of 2019, they were completely exonerated, and there was nothing negative to be found. I think the other thing that really started to raise its ugly head at that point was the fear of a downgrade, and the pricing in the bond market has a direct effect in the property sector, because remember, they're both income producers. They looked at investors as ways of generating income. So everything is always priced, even equity shares are priced relative to cash and the bond market. So there is that also came into the equation. Dividend yields or dividend growths were certainly muted as a result of what was happening in the economy at that time. but the yields were still competitive on a comparative basis. You will recall potentially that in September 2019, we wrote this article, Portfolio Positioning in an Uncertain Environment, certainly as concerns around the South African economy and the structure of the economy, and the downgrade became a little bit a bigger issue in investors' minds. And we wrote this. We wrote, an extended period of weak growth will continue to exert downward pressure on listed property. Foreign-focused, inwardly listed property stocks will be retained, as our view is that a declining rand linked to stronger GDP fundamentals in their home jurisdictions will support strong dividend growth. In other words, we were concerned about the property sector in terms of its ability to grow its income. We did think there were some counters in there that were particularly weak, and we sought to buy companies that were listed on the JSE that owned shopping centres and office parks outside of the country, but that were listed and available to South African investors. And as you know, many of those were in Eastern European jurisdictions that had double-digit growth, GDP growth. In other words, their economies were largely booming. So what did we do? We looked to reduce our exposure to weak and vulnerable holdings. In hindsight, probably elimination would have been the better deal, but bear in mind that sometimes your weaker shares are held for a higher yield, and there's always a risk-return profile with almost any investment. We looked to, in many portfolios, we brought in an additional holding of the flexible income fund, and that was largely because we believed that we could secure cash income. We knew it wasn't as good as some of those property, but we were being a little bit defensive. We were expecting that a downgrade might happen, and we thought that bond yields would spike upwards and we could secure a higher rate of income, not as good as the property, but certainly there would be an opportunity, and that certainly proved to be true in early 2020, although we didn't forecast what would cause it. Then we look to continue to increase our exposure to the foreign inward listeds, companies like Sirius, EPP, maybe a slightly higher risk one, Nepi, Rockcastle, MAS, and others. And we looked to try and make sure that we held what we believed were the quality counters at the time, Growthpoint, Storage, Vikili being examples. But bearing in mind that we were always mindful that we built portfolios on an income demand basis for clients. And that's very much still our focus. So investor sentiment remained weak coming into 2019, and we can see here is that the real estate sector in the unit trust space showed steady sellers, and this forces asset managers to liquidate. So if we look during the 2019 year, the overall sector, so the real estate sector in the unit trust space saw zero growth, as we can see there. Yet they had net redemptions of 2.3 billion, and that was basically 5% of the sector that was redeemed by the man in the street. Now, when an asset manager is losing 5% of this fund, he has to sell, and very often he has to sell the liquid stocks in order to provide it. So we had more sellers than buyers, and that continued into the first quarter of 2020. We've seen the decline there. As you can see, the sector down 44% over the first quarter. That's up to the end of March of 2020, and a further 630 million of net sales. So more money leaving the sector. So there's nothing to underpin prices from that perspective as investors flee the sector. Then we saw in March, and here this graph really takes us from the start of the market in January. We can see the market not doing anything particularly crazy in early January, and then as the coronavirus broke and lockdowns broke around the globe, shopping centres were shut down, people were sent home, tenants indicated that they weren't going to pay their rentals. We can see there was a massive downgrade in the market price In addition, at that same time, we were downgraded, which had a further knock-on effect. And there was only a small sort of protection for the foreign inward invested companies as a result of the devaluation of the rand. But they were also impacted as shopping centres closed right around the globe. So we believe that there was an absolute perfect storm in the property sector, and we can attribute it to four things, four concurrent events that led to buyers retreating and prices collapsing. And we think these are the four things, and hopefully we can demonstrate that we think some of them are going to turn positive in a little while. So firstly, global sentiment. As the COVID-19 was declared a pandemic, every asset class, including gold, initially came under pressure. And so bear in mind that our base case view for 2020 was that we would have a fairly positive global economy. Obviously, this is a complete 180-degree turn. We've gone from positive environment to completely concerned global environment, and this weighed heavily on global sentiment. Then the second aspect was that in the midst of this, at the same time, South Africa was downgraded. This led to our rand blowing out to north of 23 to the pound and 19 to the dollar. Our bond yields spiked massively, roughly from 8.5% yield to nearly 10.5, 11. And as a result, because property is priced relative to bonds, and the yield went up, which is exactly what would happen in the property space as well, the prices had to fall to make that adjustment. And so that was also a big impact. The third thing is the lockdowns. Now, because we had locked down all commercial activity, people weren't allowed to go to shopping centres, they couldn't go to malls, they couldn't go and work in their offices, they had to stay home. As work from home came into focus, we saw that there was concern around the property companies being able to pay their investors an income. And as a result, if there was concern on the income, why would someone want to buy or pay until they knew what was going to happen? So this is a sector-specific issue. So we've seen, firstly, a global economy issue. Secondly, a relative pricing issue. Thirdly, a sector-specific issue in terms of the underlying business case. And then the fourth thing is that South Africa was already in a recessionary environment. And so that was the fourth thing that came at the same time, South African economy under pressure. And so that was a local economy specific issue. This we would believe would be the perfect storm. But we believe for those reasons, understanding each of these and how they might play out certainly underpins why we shouldn't abandon it as a long-term investment or as a source of income into retirement. So let's have a look, first of all, global sentiment recovery. I think one of the things, there's been many newspaper commentary, I've seen many articles aligning what's going to happen now to the Great Depression, and certainly we're going to see major unemployment, we are going to see some financial hardship around the globe. But I think economists are fairly unanimous in agreeing that the difference between the global recession that we are going to face now and the Great Depression, as it is known from the 1900s, is quite different from the point of view where back then governments did not make any sort of liquidity available for business. There was no benefits or support into the business space, and as a result, it had to fend for itself. We have seen completely the opposite, and in fact, governments have learned from being a little bit slow in 2008, 2009 during the global financial crisis, and they have moved incredibly swiftly to pour volumes of money into markets to support and provide liquidity. In addition, we've seen central banks drop interest rates extremely aggressively. We have seen that locally. We've had cuts here in South Africa. And as a result, we do believe that sentiment is going to recover. We've already seen that as China gets back to normal, there has been a little bit of sentiment recovery from that point of view. The second thing was that while we do believe that the downgrade means that the SA government has to borrow at higher rates and has led to a weaker rand initially and higher bond rates, we think that globally, because of the cut in interest rates in terms of bond markets around the world, there is going to be a renewed hunt for yield as baby boomers seek income. And South Africa's higher yield relative to what is happening in developed markets is going to make them, at the margin, attractive for a little bit of risk yield into portfolios. So we believe actually it's come at a good time. The downgrade has come at a time when foreign interest rates are really low, and that is going to make us a little bit more attractive. And we've certainly seen a little bit of recovery in the bond market from that perspective. And so we're already on our shorter bond rates down under the 9% from that perspective. The third thing is that the lockdowns are being released. So as much as there was a panic about no trading, no paying rents, we do see that the lockdowns are being released. China is unlocking. Europe is starting to unlock to some extent. We see some of the states in America are starting to open a little bit. And this will look at a growing and a resumption of economic activity, which should see rentals restored and probably be a situation where in this sector, particularly, some of the concern about no income may be mitigated to some extent. The fourth thing is that SA is in a recession, and it's highly possible that what has happened now is going to make our recession even worse and take longer for us to get out. So this is probably the one that doesn't turn around particularly quickly like the other three, and certainly will remain as a negative into the space. But we do think that there is the potential that some of the economic reforms that might have been mooted could be pushed through a little bit more easily in the current environment than had they been a little bit different and this hadn't happened in the past. So we are hopeful that potentially that's the positive and upside we could see out of this. So what I'd like to do, looking at the sort of bigger picture, I always feel that it helps to put numbers to something. And there on your screen, you'll see the chart is producing a run of growth point going back to December of 2018. You can see the share hadn't really done much over the 2019 year and absolutely plummeted in March, as we all know. And there, the table that's come up will show you the dividends that have been paid per share going back to 2016. And you can see quite a steady increase in the dividend relative to fairly low inflation rates. The question mark is around 2020. But I want to look at these figures overall. And so I'm going to use an example out of Growth Point for an individual investor. And what I'm going to do is I'm going to say, let's consider January of this year that you held 100,000 Rand equivalent in Growth Point. And Growth Point on the first trading day of January was trading at 22 Rand 41 a share, which means that you would have held 4,462 shares. That means that by the end of April of this year, Growth Point had dropped to 13 Rand 93 a share. So your 4,462 shares would now be worth 62,159, a decline of 38%. Interestingly to note, at the height of the crisis, Growth Point traded and touched at 10 Rand a share, and so we have seen a little bit of recovery from that perspective. But let's look at the picture going forward, both from a value and an income point of view. So if we start to put numbers to the exercise, I'm going to go back 3 years, and one of the reasons I've done this is because I want to reiterate that even if you're a retiree, investing is not a 6-month game. You are retiring for a long time. You may still have 5, 10, 15, 20 years of retirement left. And so your investment decisions need to not just be looking at the short term, they need to take some sort of long term into account. So I've looked back at the previous 3 years, 17, 18, and 19, and said if I'd owned 4,462 shares in Growthpoint, how much income would I actually have banked? And there you can see the numbers: 8,737 in 17, 9,300 in 18, and 9,700 in 2019. Now, what do the projections look like? Well, again, I've gone forward 3 years, and we have sourced these projections from a company called Renaissance Capital. It's one of the stockbroking firms that provides us with research that we use to do our analysis. And this is what they are projecting will be the income going forward over the next 3 years. So they have indicated that for the full 2020 year, Growthpoint is likely to drop its income by 8%. They then believe in 2021 that it will recover by 15.5% off that low base, and in the following year it will grow by a further 6.8%. What that means for the actual investor who owns 4,462 shares is that in 2020 they will get 8,937 Rand. In 2021 they will get 10,321 Rand, and in 2022 they will get 11,026. Now, in order to make the comparison make sense to us as investors, what I've done is I've said, well, how does that compare to selling out my shares, taking my 62,000 and going and getting some sort of fixed yield elsewhere? Well, the next column will show you that. So the yield at the current market value, if they are correct and we see an 8% decline, that's the equivalent to 14.4% on my 62,000. The following year would be 16.6%, and the year after that 17.7%. But we still have time to unfold. So what I've done in this next chart is I've said, well, what if we halved the analyst's expectations? In other words, let's assume that it's twice as bad as he thinks it's going to be in 2020. In other words, down 16%. And let's assume in 2021 and 2022, they're only half as good as he indicates. In other words, it only comes up 7.5% in 2021 and up 3.4% in 2022. How will I look then? Well, my actual income will be 8,175 this year, down 16%. I will still be getting a yield on my 62,000 of 13.2%. In the following year, 8,829, that's a yield of 14.2%. And in 2022, 9,138, that's a yield of 14.7%. And ladies and gents, if I look at that and I compare that to where I can take my money at this point, which is where investors think that they should be moving to, I've compared it to money market, which is currently offering 6%, a 32-day call, which is offering you 4.2%. You could go and buy retail savings bonds. I hear them being advertised on the radio. You would be fixed for 5 years, and that would give you a 10% yield. Or you could get a 5-year fixed deposit at one of the local banks, and they would offer you 7%. I do want to point out that these rates are likely to decline between 15 and 20% in the coming weeks. And that's really because of the cut in interest rates, and we expect more cut in interest rates from our central banks as inflation disappears, and certainly they try and stimulate the economy. The last column is the one I want to point out, and I think it is most relevant for investors. If you were to sell and crystallize your loss and walk away with your 62,000, not only are you going to get less in the way of yield anywhere else, but there is zero chance of capital recovery over the next 2 years. Now, it's hard to know exactly to what extent Growthpoint is going to recover, and so I've put a range there of 20 to 40% plus from here. But certainly we believe that there's every chance that there could be a strong recovery in this market going forward, and that might become a little bit more prevalent or evident in Michael's presentation in the second half when we release that. So let's look in a little bit more detail. So let's assume an investor, and going back to our example, what if you wanted to draw the same income in 2019, but as we've indicated, we're not going to pay out the same income? Well, what that means is that I'm going to have to either sell shares, if I own the growth point shares, to make up the difference, if I don't want to reduce the income. But even if I went into any one of those other asset classes, I would have to redeem some form of capital in order to get that. So what this next chart does is it looks at your year-end market value of the investment, um, based on each of those assets that you could potentially move into, starting at 62,000, drawing the same income as you got from your growth point in 2019, and then it will plot the end value over the next 3 years. And bearing in mind what I have also done here is I've assumed that there is no growth in the growth point share. It stays at 13.93 over that full 3-year period. This is what the graph looks like. So the red is the 32-day call, the green is the money market, the light blue is the 5-year fixed deposit, the dark blue is the retail notes, the purple, the dark purple, is the growth point, assuming RenCap, our analyst, is correct, and the light purple, or the cerise, if you want to call it, assumes the double or half scenario that I painted over that period. But as you can see, and I do want to point out before I go to the next section, over the 3-year period, look at how going into the cash secure at a lower yield eats your capital away as you're drawing the same income. They all go down a little bit. Obviously, if the analyst expectations are met, actually you're pretty much in the same position from a capital point of view over the next 3 years. But if you go to a lower yield, your capital is definitely going to decline quite significantly. As you can see in the 32-day call, there would be quite big capital destruction. But what if we were to see modest recovery in the growth point shares over the following 3 years? So let's assume we don't see anything move during the rest of 2020, but in 2021 we see the growth point share price move from 13.93 to 16.02, and you can see that your 62,000 would move to just under 70,000 rand. And in the following year, 2022, if we moved just under halfway back from where we started, another 10% up, then you would be roughly at 75,000, with actually quite a strong recovery. And the difference between that and crystallizing your loss and going for a lower yield would be absolutely significant. So coming to a conclusion, we do understand why listed property share prices have been under pressure. Poor local economic conditions and negative global investor sentiment towards the property sector. We've gone through those March perfect storm events that have left, particularly the Rand collapse, the credit downgrade, and the lockdown. And we believe that while rentals are under pressure and interim dividends may be withheld during the middle of 2020, our analysis still suggests that 2020 income will exceed the yields available from alternative sources. And so while you have really suffered a horrible Q1 of 2020, and it's really shown in your share prices and your market values, we really believe that now is not the time to abandon the sector. We believe the Harvard House income philosophy remains intact and very relevant. Share prices are depressed, but the possibility of a strong revival over the next 2 to 3 years are absolutely compelling. And I'm going to finish this with a quote from Warren Buffett. But please do tune in to get our second half of this presentation, where Michael will look in greater technicality on one or two holdings that we have. But leaving you with this, Warren Buffett saying, today people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. So ladies and gentlemen, thank you for the time. Thank you for taking the time to tune in. If you have any queries, please don't hesitate to send them through to us, or contact your financial advisor. And we really appreciate you taking the time to listen to our presentations. Thank you and goodbye.